You've probably heard this advice 100 times. Just throw your money into an index fund and forget about it. It's on every finance TikTok, every Reddit thread, every "How I Retired Early" post. But here's the truth: that advice is dangerously incomplete. Not wrong exactly, but incomplete in a way that could actually hurt you if you take it too literally. Today, we're breaking down what index fund investing actually requires versus what social media tells you it requires. We'll define what an index fund really is, walk through real numbers, bust the totally passive forever myth, run through a case study with two investors who both think they're doing the same thing, and back it up with real research on investor behavior. By the end, you'll know exactly what set and forget should really mean. Quick disclaimer: I'm not a financial advisor. This isn't financial advice, just information to help you think clearly about your own investing. Let's dive in. Think of an index fund like a fruit basket. Instead of buying one single apple, instead of picking one company's stock and betting everything on it, an index fund automatically holds a slice of hundreds, sometimes thousands, of different companies at once. If one apple in the basket goes bad, it barely affects the whole basket. Technically, an index fund is a type of investment fund designed to track the performance of a specific market index, which represents roughly 500 of the largest publicly traded companies in the US. Instead of a fund manager actively picking winners and losers, the fund simply mirrors whatever that index does. There are a few different flavors here too. Some index funds track broad markets, like the total stock market. Others track narrower slices, like just tech companies, or just international markets, or just bonds. Index fund isn't one single thing, it's a category, and which one you pick actually matters. Let's put real numbers on this. Say you invest $10,000 into a broad market index fund with a low expense ratio, something like 0.03% to 0.1% a year. On that $10,000, you might pay somewhere between $3 and $10 a year in fees. That's the low-cost part of the pitch, and it's genuinely true. That's dramatically cheaper than most actively managed funds, which can charge 1% or more, meaning $100 a year on that same $10,000. But here's what the set and forget crowd skips over: that same $10,000, sitting in one single index fund, is still fully exposed to the ups and downs of the entire market. If the market drops 20% in a bad year, your $10,000 becomes $8,000, fees or no fees. Nobody's flagging that for you. Nobody's rebalancing it for you. That part isn't automatic, that part is on you. Now stretch that same idea out to a full portfolio, not just one fund. Say you started at 90% stocks and 10% bonds in your 20s, which is pretty typical for someone with decades until retirement. If stocks have a strong run over several years, that ratio can quietly drift to something like 95% stocks and 5% bonds, without you touching a thing, simply because stocks grew faster than bonds. Nobody sends you an alert about that drift. If you genuinely never check in, you might not realize your risk level crept up right until a downturn hits, and you feel it a lot harder than you expected to. Here's the myth I really want to break down: index funds require zero ongoing attention. That's only half true, and the missing half is the part that actually determines whether this works for you long term. What's genuinely true: you don't need to pick individual stocks, you don't need to time your entry perfectly, and you don't need to constantly trade in and out. What's not true: you still need to decide how much of your portfolio should be in stocks versus bonds based on your age and risk tolerance. You still need to periodically rebalance as your allocation drifts over time, and you still need enough discipline to not panic sell during a downturn. Set and forget doesn't mean set it and never think about your finances again. It means you're not actively trading, but you're not off the hook completely either. Let's meet Priya and Devin. Priya heard set and forget and took it literally. She put her entire portfolio into one single index fund in her 20s and genuinely never looked at it again. Not to rebalance, not to check her allocation, even to keep contributing regularly. She figured the fund would just handle everything. Devin heard the same advice, but understood it a little differently. Devin also invested in a low-cost broad index fund, but kept contributing consistently every month, checked in roughly once a year to make sure the stock-to-bond mix still matched their risk tolerance as they got older, and critically didn't touch anything during market downturns, even when it was uncomfortable. Fast forward 20 years. Priya's portfolio grew, because the market generally grows over long periods, but she also stopped contributing new money somewhere along the way when life got busy, and never adjusted her risk exposure as retirement got closer, meaning she was still fully exposed to stock market swings right when she could least afford a downturn. Devon's portfolio grew too, but with steady new contributions compounding the whole way, and a gradually more conservative allocation as retirement approached, which meant a market dip in Devon's final working years didn't hit nearly as hard. Same starting advice. Same phrase. Set and forget. Two very different outcomes, because one of them treated it as truly zero maintenance, and the other understood it as low maintenance, not no maintenance. Neither Priya nor Devon did anything reckless. Neither one panic sold or chased hot stocks. That's actually the whole point. This isn't a story about someone making a dramatic mistake. It's a story about how a tiny difference in interpreting one piece of advice compounds over 2 decades into a meaningfully different outcome just through small, quiet neglect versus small, quiet attention. This connects to something Hartford funds and similar research groups have highlighted for years, that investor behavior, not fund selection, tends to be the single biggest factor separating good outcomes from mediocre ones. Investors who stay consistently invested and periodically rebalance tend to significantly outperform investors who either panic sell during downturns or simply neglect their portfolio's changing risk profile over time. The fund itself is rarely the problem. The behavior around the fund usually is. Let's be fair to both sides of this. Index fund pros: low FEs, broad diversification, no need to pick individual winners, historically strong long-term returns for the overall market, and it removes a lot of the stress of active stock picking. Index fund cons: you're still exposed to full market volatility, there's no active management to protect you during a crash, and it genuinely still requires occasional check-ins, annual rebalancing, adjusting your allocation as you age, staying consistent with contributions. The set and forget pitch gets the fee and diversification part right. It just oversells the forget part. It's worth naming one more con too. Index funds, by design, can't protect you from a broad market-wide downturn, because they're built to move with the market, not around it. If the entire index drops, your fund drops with it. That's a very different risk profile than a lot of people assume when they hear safe, boring, low-effort investment. Here's why this actually matters for your behavior. When people believe something is truly zero maintenance, they tend to disengage completely. No annual check-ins, no adjustments as life circumstances change, sometimes even forgetting to keep contributing. That's not laziness, that's just what happens when the marketing message says, forget about it, a little too literally. There's also a loss aversion trap hiding in here. If you've genuinely forgotten about your account for years and then check it during a downturn, seeing a big unexpected drop can trigger a much stronger panic reaction than if you'd been checking in periodically and building comfort with normal market fluctuations along the way. So is set and forget good advice or bad advice? Honestly, it depends on how literally you take it. As a way to avoid obsessively checking your portfolio every day, or avoid trying to time the market, it's genuinely good advice. As a literal instruction to never think about your investments again, it can leave your risk exposure badly mismatched to your actual life stage by the time you need the money. The real version of this advice should probably be, set it, keep contributing, and check in about once a year, which admittedly doesn't fit quite as cleanly into a 15-second video. If this reframed how you think about set and forget investing, drop a like. It really helps this channel grow. And I want to know in the comments, be honest, when's the last time you actually checked your portfolio's allocation? Let me know below. If you want to go deeper on how to actually rebalance your portfolio as you get older, I've got a video on that right here. Check it out next. Thanks for watching, and I'll see you in the next one.